I'm so tired, I haven't slept a wink. I'm so tired, my mind is on the blink. I wonder, should I get up and fix myself a drink? No, no, no.
Good evening, everyone, and welcome to another kind of exciting episode of Bond Squad After Hours. In case you didn't get the message by my intro song, I'm so tired. This has been a very tiring week around here with equity markets, very volatile, bond markets giving off all kinds of signals. My days, have been running pretty much from 6 in the morning to 12:30, right after midnight. So if no props tonight, no interesting attire, just a very tired Bond Squad strategist. So before we get started, let's read the disclaimer so the thought police do not take me away. They're doing that in China, by the way, the past couple days in this industry, but hopefully this will do the trick over here. Investment advice offered through Private Advisor Group, a registered investment advisor. Wealth Strategies and Management and PAG are separate entities. The opinions voiced in this material offer general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and there's no guarantee of future results. And I'd like to add, no animals, not even the little blind cat back there, were harmed in the making of this broadcast. Hopefully compliance won't be too upset with that bit of levity. But, right now we need a bit of levity. It's been quite exhausting. We had over a week of straight down days. And we had some reprieve most of yesterday until we gave it up at the end. Today, we finally had a rally in equities. Now, usually I don't speak about equities. I'm a bond strategist, right? So, excuse me, also very dry. That's just lemonade. I wish it was stronger, but it's not. But the equity markets have finally caught up to the bond market. Bond market for more than a year was indicating that there was something wrong. Credit spreads have blown out, okay? We saw junk spreads, triple C rated spreads, go from about 600 over treasuries in the belly of the curve, 5 to 7 years, to almost 1,100 over treasuries, almost doubled. The bond market was telling you that there are cracks on balance sheets. In the equity market, we just had pundits on crack. We think they were saying nothing's wrong. The bond market has it wrong. Nothing. China is fine. You don't understand China. Oh, and when they devalued the currency, just make the IMF happy. We don't think the IMF is really happy with China at this point. And the equity market caught on to that, especially when they looked around and saw valuations, even the valuation of U.S. companies who do business in China or which do business in China, and said, you know what, these companies might be good, but China's growth is probably not going to be anywhere near what was priced into the equity markets. So they took them down, and they took them down, and they took them down. And there was a sense that when is this going to stop? It was started to be a negative feedback loop, right? Well, the chart that we opened up with when we played our intro music is a very interesting chart because it kind of gives a clue as to why we saw the selling really catch fire here. And see if I can bring it back up again here. This chart is the chart of margin debt. I'm sorry, is that the margin debt one? Yeah, this is the margin debt one. This is the right chart. Okay. Now let's bring it back a little farther. 05, let's go. 01, 2000. Right? So we get to the height of the tech bubble. Look at the margin here. Look how much it's grown. Now, I know this is not adjusted for inflation and all that, but come on. Even adjusted for inflation, this shouldn't be that high. There's way too much margin on NYSE member balance sheets. See, NYSE firms' debit balances. Okay, there was way too much leverage here. So what happens when stocks go down? You get margin calls, which makes stocks go down, which gives margin calls, which makes stocks go down, so on and so on. Today, we did not have that selling at near the end of the day. The margin calls weren't there. So that might give us some temporary stability in the market. It's probably not going to be a bottom here. Who knows? Maybe it is. But bottoms very rarely bounce like that. But you know what? We're in a new world. We're in QE bizarro world. So anything is possible. We could see a V-shaped bottom. But I don't know. The bond market's not telling us that. Now, the bond market always leads the stock market. No, almost always. We won't say always. Always is a long time. So is never. But as one of our City/Smith Barney alumnus reminded us yesterday, the stock market is the bond market's less intelligent cousin. And it does. It doesn't. The stock market's all hopes, dreams, possibilities. The bond market says, what's on your balance sheet? What does it look like? What's your default probability? And it goes from there. So, and we'll share another screen here. And this is an interesting one too. As soon as I can get back over, another screen. And this is an interesting one, I think, if it'll come up for me. Or maybe it won't come up. Is this the one I want here? Share. This is the one. Okay, this is the credit spread of A-rated corporate bonds of all maturities on average, and how they've widened. So this time last year, A-rated corporate bonds were roughly 80 basis points over Treasuries. So if Treasuries last year were about 2.5, which they were, this is 80 basis points. You can get about 330 on a corporate bond. Now they've widened to about 126, and the word on the street today is that they were widening very lightly, but still widening. This reflects increased credit risk. And I didn't go to CCC. I did publish CCC on two of my most recent reports, and they're like almost 1,100, as I mentioned in the beginning of this conversation. So we're 126 basis points over Treasuries. So that means now we have the 10-year Treasury sitting as we speak at about 218. So you're 318, so you're about let's round it, you're about 340, 345 over 330, 345 is your yield on a 10-year corporate bond, A-rated. So basically, the actual yields of corporate bonds really haven't moved much. Moved around 330 here, about 340 here, but the spread has widened out. The risk premium has widened out. So they did not rally with Treasuries. When Treasuries went down, all right, they went down because of slowing inflation, maybe slowing a global economy. The corporate bond yields stayed wide, or stayed where they were and widened out to reflect the fact that things look worse for corporations. If things were just fine, they would have rallied along with Treasuries, and you would have had a flat line going across the screen. You don't have it, right? So the bond market is telling us that the situation not healed among corporations. Another thing we like to highlight, and we'll switch the screen live for you here, hopefully this still works, is the price of crude oil, right? Crude oil, it was little change. It was down most of the day, came up in after hours trading, as you can see it flashing, but it finished the day down, right? The demand story is really lacking, all right? China is not increasing its consumption of petroleum as fast as we thought. Neither are most of the rest of the world, and we're producing more than ever. And now we have the end of the summer driving season upon us, which is going to cause less demand for oil and refined products such as gasoline. So that's not going to be good for that sector. Another area I have to look at is metals, especially iron ore. Now there's word that China is going to recycle steel, old appliances, maybe even old building materials. Maybe they're going to tear down their ghost cities, recycle it, and sell raw steel, much as a steel producer might. Remember, steel can be recycled an infinite amount of times. You can take steel, melt it down, make something out of it, melt it down again, make something out of it. So China's sitting with all this steel that they don't need, both never used and built and manufactured into buildings, equipment, whatever they don't need, that they can melt down and sell it. So there's the idea that China is gonna flood the market with that to help boost up their economy. It's almost like the oil story all over again, right? It's better to get something for it, even if it drives the price of steel down. It's better to get something, not getting anything for it now. So we think we're still in a pretty disinflationary environment. And if you look down here at the U.S. 10-year, we're at 217 now on the 10-year. And this is actually trading in overseas trading at this point, or after hours trading. And we notice what happened on the 10-year. We didn't see it go much below 2 at the height of the panic. But even with this relief, like China's a house of cards. But we'll get to that in a second. It's only 217. 217. All right. That's telling you that the bond market doesn't see inflation. Well, why did it rally at all? 2 reasons. The main reason that I think, and this is since I mentioned it the other day, and I mentioned it on a call we had with Guy Adami, who's apparently a fan of mine. I didn't know that. Thank you for the kind words the other day, Guy. Is that we had foreign central banks out there selling their treasury holdings to get dollars, which can then be sold and repatriated back into their home currencies to moderate or halt the slide. You want lower currencies to export. You don't want your currencies fall out of bed. That's inflationary. All of a sudden, if you have hyper currency devaluation, you have hyperinflation, and your consumers take it on the chin. So that's probably part of it, and we might see it stabilize here. The other part of it is we've heard more and more comments that the Fed might delay tightening. Even New York Fed President Dudley came out today and said that it was somewhat less likely as of right now, but it could be bad. It could be more likely depending on the economic data, which, quite frankly, has been not spectacular, especially considered zero interest rates, but it's been good. It's been solid. We'll be honest, it's been solid. So, where's the 10-year going? Oh, I'm going to finish that thought. Sorry. So if the Fed delays tightening, right, that's inflationary. Now think about it. When the Fed wants to combat inflation, it tightens. It makes money harder to get. When it wants to encourage inflation, it eases, right? So if it doesn't tighten, it's kind of a de facto ease. So that's inflationary. So if the Fed delays, long rates should move up. And it's amazing the conversations we have that no one gets this outside of the bond geeks. That when the Fed raises rates doesn't mean all rates move up. We're asked by a very knowledgeable professional today, asked us, all right, if the Fed funds rate is at 2, where's the long bond? 4? I said, no, it could be at 3, it could be at 2. We have a flat curve. The long end response to inflation when the Fed doesn't have its hands all over it, which it never had before the twist and then QE3 or QE infinity. So the bond market's telling us that we don't have much to fear in the way of inflation. And it's also telling us in the credit markets that things are not all copacetic there. Right? Bond Squad's official opinion, and my personal opinion, is that we're going to see a pretty severe, at some point we think, or let's say pretty significant correction or continued correction in the high yield market, where corporate defaults really start to come up, even if the Fed stays relatively accommodative. The cat's out of the bag. They know that some of these junk rated companies, especially some of the more highly leveraged energy producers, are insolvent or will be insolvent or should be insolvent if oil prices stay down here. And it'll bleed over to other commodities too. We heard from a subscriber today that one investment company, it was going through her office saying, hey, there's a bond bubble that's going to burst. We think we'll have one more rally and then boom, rates are going to pop. Really? You think rates are going to pop? Long end always moves with inflation. It does not move with growth. Not that growth's going to be off the board. So unless you have inflation through consumption or investors vacating the dollar, which would weaken it and cause inflation, and would cause them probably to sell treasuries, it's very unlikely we're going to see a sharp spike in treasury yields. So enough of the screen. You get to see my made for radio face now. So if you can get back here, there we are. You saw me, I couldn't see me. So we don't think that there's a bond bubble in treasuries. How can there be a bond bubble in treasuries? It's not like everybody flooded into treasuries. In fact, everybody flooded out on the risk curve. They flooded into junk, right? So treasuries will sell off if and when inflation pressures build. And that's not on the horizon. The 10-year tips break even is somewhere between 155 and 160 the last we looked. That means it thinks that inflation averages over the next 10 years between 155 and 160, 1.6%. Okay? That is not high inflation. That is not conducive of a 10-year or a 30-year treasury yield blowing out. So these, this will sound unprofessional. Knuckleheads who come in and claim bond bubbles and this is going to happen, they don't know what they're talking about. For one thing, we've never been here before. I don't know what's going to happen, but I know how the bond market will react or should react to various conditions. The long end, outside of intervention, should sell off when we have stronger inflation pressures. Good luck. There's no inflation out there. Even with this productivity gain that we saw today in capital goods, which were healthy today, the question is how much of that is going to require additional workers and wage growth, or will it just supplant workers? We're that advanced in technology that we no longer need both. We don't in many instances we no longer need both workers and better equipment. It's either or in many instances. So we don't know how that's going to play out. So tomorrow we'll get the second look at Q2 GDP. Now the street consensus is that our original 2.3 print will be upgraded to 3.2. Sounds logical. So if we do print it 3.2 and we combine that with the 0.6% we got in the first quarter after the new methodology was used, that gives us an average for the first half of the year of a U.S. growth at 1.85% annualized. That would be exactly what we averaged for the first half of last year. The Atlanta Fed's GDP now, forecast has to be updated, probably updated later this week, but has us tracking just below 2%. Their blue chip forecast, the Atlanta Fed, which is a survey of economists, had it at 3, but now it's sinking through the 2s. So it looks like it's going to converge somewhere between 2 and 2.5 again. So it looks like the U.S. economy is stuck in and around 2%, plus or minus 50 basis points, depending on what headwinds come from overseas. All right, we don't have the dollar devaluing. If the Fed raises rates, that should strengthen the dollar. It's just a matter of how much is built into that. We think quite a lot was because if we look at how, and let's see if we can share this screen. This would be a good one. We'll get here. Let's see. Here we go. If I go here, EUR, currency go, GP, you'll see something here. You'll see right in here, up until the past 2 days, the euro was actually starting to regain some strength, nowhere near where it was, on the idea that the Fed might pause or delay its tightening. And you got a little bit of weakness here in the dollar because the rates might not rise, but then it looked like then some Fed comments that they might still be on the table for September. So if the Fed delays, we could see some dollar weakness against the developed currencies, the euro and the Japanese yen. However, when we look at Brazil here, our currency GP go, and against our emerging market currencies. And remember, this is inverted. So this is 3.59 real to the US dollar. All right. The other one was $1.15 to the euro. So as this goes up, it means the real is weakening. That's probably still going to continue. Brazil is a mess. Russia's a mess. Venezuela is a mess. China's probably growing somewhere between 3 and 5%, maybe. Well, we're not in love with the China story, but we think that the dollar keeps getting stronger against these emerging economies, which would be good if they were if exports, except what they're exporting are commodities in which there's a glut, and we can produce all we need. So we don't care how low it goes. We are not buying from you. So we're not bullish on EM. Be careful about the idea. Oh, we're about managers will come in and say, but we're investing internally on internal demand, internal corporations. Problem is, over the past several years, many of these corporations in emerging economies borrowed in U.S. dollars. They issued bonds in U.S. dollars. As their currencies weaken, the cost of their repaying the debt and making interest payments goes up. So, a Brazilian company might have been able to borrow at 5% for 5 years a few years ago, instead of 8% in Brazil and in the Brazilian real, and it's a savings. But now, if the real falls 20% versus the dollar, well, their cost of the debt cost goes up 20%. All right, so the currency kills it. And you as an investor, even though you have a U.S. dollar bond, you get hit because that depreciating currency, right? It reduces the credit quality, erodes the company's ability to pay the debt, and you start seeing delinquencies and defaults and debt restructurings, and before you know it, you're worked out at 50 cents on the dollar. They don't tell you that too when you go. And it's amazing the information that goes around this industry, and the lack of fixed income and market and economic knowledge that resides in the wealth management business these days. The demographic of Bond Squad subscribers is somewhere in the low to mid 50 years of age. The younger advisors, they don't care. They don't seem to care. With few exceptions. We have one new subscriber who's young, and hopefully getting off on the right track. She's a good mentor, another one of our subscribers. But for the most part, they want to sell you a package of whatever, and they don't quite understand how it works. And the strategy is being written by people who don't quite understand how it works, like great tips, like a great tips call earlier this year, and inflation's gone down. So good luck with that. The Fed, the Fed officials are all in Jackson Hole, Wyoming now, probably having something better to drink than I am, and they'll start speaking tomorrow, starting with Fed Vice Chair Stanley Fischer. So the markets will be listening to that. The equity markets are hoping that the Fed comments say that they're holding off. I hope that the Fed says that the tightening is still on the table. In my report today, I explained that tightening could be good for the economy, right? You have a larger proportion of the population which are depending on investment income. Well, lower rates hurt that. So in the past, where you had baby boomers, when they were in their prime earning years, wanted lower rates so they can borrow and spend and take equity out of the house. Now these same boomers are saying, man, can somebody give us a good T-bill rate, a good CD rate? We need that income with which to spend. So now, and we explained this the other day too, because of that, rates that are too low, right, can cause disinflation. You lower the price of energy, right, because everybody could get cheap financing for drilling projects. So you had a glut of energy. Trust me, if the Fed funds rate was at 3, 4, or 5, and the 10-year was sitting at a more typical 4 or 5%, and these companies, these junk-rated or non-rated companies looking for credit a few years ago to go drilling for oil and squeezing it out of shale, they'd have to pay 8, 9, 10, 11, maybe 12% for the financing. Probably not able to afford it, but they paid 5, 6, 7%. Got the deals done. So that brought inflation down by bringing down commodity prices. It blew up some emerging economies, but low rates is designed to increase prices, right? But increase asset prices, not consumer prices, because the U.S. consumer wasn't ready, willing, or able to go borrow like drunken sailors again and spend on things they didn't need. So we were in a situation where it's possible to have rates too low, bring them too high, borrowing stops and business ventures stop. Too low, you have income-oriented consumers can't spend, so you bring it up a bit, all right? That could rain on the parade of the equity market, at least initially. Now, if anybody in that market had half a brain, which I'm sure many people do, they would say, hey, higher rates are good for consumer cyclicals. They're good for consumer staples. They're good for any company that's not over leveraged. It's bad for companies that borrowed to buy back stocks, because when they have to refinance that debt, they probably can't. So what they'll do, they issue stock again to raise cash, dilute the shareholders, pay the debt off, and the stock goes down. So what you want to look at in this, and I'm not an equity geek, but you want to look for companies that don't have to sell shares to replace maturing debt a few years down the road. You want dividend stocks, you want solid companies, and you want that in the bond market too, by the way. And the Fed, I think the comments out of the Fed are going to be middle of the road to somewhat hawkish, with the exception of, well, depending who speaks. If you hear from Boston Fed President Rosengrant or Chicago Fed President Evans, yeah, you might get a double stamp. But Lockhart, the Fed Atlanta Fed president, said, hey, he backed away from September, but he said, you know what, a tightening's probably coming in 2015. We think that happens, so we think you should prepare. We think that the pain is not over in equities, but it might be mostly over. Our advice for in all risk assets, and we speak mostly of the lower areas of the credit markets, but it applies to equities too, in our opinion, because really, what's a junk bond? It's an equity with a coupon. And by the way, my opinion, should never be bought ever by a junk bond, especially something below double B, for the purpose of enhancing income. Somebody who's doing that doesn't understand. In that area of the credit markets, receiving par at maturity is not a foregone conclusion. Typically, they're looking to get more for the bonds than what they pay the market participants. So what they want to do is maybe buy it at 50 cents on the dollar, and maybe they can sell it at 60 cents or 70 cents when it looks like that's where creditors might be worked out in a debt restructuring or a bankruptcy. If they get par, yay, they do cartwheels. But that's not the primary reason for owning junk bonds, for income, that is. It's definitely a total return asset class. So we suggest that people have too much exposure in EM debt, in U.S. junk debt, move up in quality. That's funny. We've been saying that for well over a year, and now the other day, Mohamed El-Arian said to move up in quality. Look for countries and companies with the biggest and best balance sheets. Well, we've been saying that for a year, and if you did that, you didn't get the big blowout in credit spreads, and your prices stayed pretty much the same. And unlike the junk debt, which actually their prices went down, even though Treasury prices went up, it's really not that difficult. But you got to get out of the mindset that you can buy a packaged product that gives you diversification, and it takes care of everything. We can buy like the handy dandy kitchen utensil. We should bring it on YouTube and let you watch it from the honeymooners, right? It's impossible to get one tool that does it all. You can buy a diverse portfolio of something that targets a specific date or specific outcome. It's not quite as good as owning a real bond portfolio. You can include that in a bond portfolio, some other ways of investing in fixed income, but it's really not a replacement for it. And we don't suggest people do that. We think you should be investing for your needs, your risk tolerance. Build yourself a bond portfolio if you have the capital to do so. If not, I can't mention a certain product without, I don't think even on video, without paying FINRA, but look for any investment vehicle that has a defined maturity date, be it a bond, a $25 par note, or some of the junior sub preferreds out there. Kane Anderson has them, but they're going to be called soon, I think. But something with a final maturity date that when, no matter where interest rates are, just in case, you're going to get par at maturity. That's what you want. You don't want to turn your fixed income into a total return gamble. If you're an equity and if you're a income and capital preservation investor. And by the way, that great rotation that Merrill talked about a few years ago, Bank of America Merrill now, that never happened because it was an apples and orange thing. Most of the money that shifted out of treasuries went to junk. It wasn't sitting in treasuries. It wasn't going to rotate out of treasuries into equities. It already rotated out of quality. It already went out the risk curve. There was nothing to go into equities. So the whole idea that money comes from treasuries and goes to equities, then goes from equities back to treasuries, that happens at the margins, but for the most part it doesn't. And the bond market's full of sticky money. You have pensions, insurance companies, endowments that have actuarial needs. They buy bonds come heck or high water. It doesn't really matter to them where rates are. And see if we can give you one last treat here before we let you go, because we're a little over, but we think you'll like this. And give me a second to get it rolling here. And just bear with me here, and you'll appreciate this, because this is the investment industry today. If I can get it to roll, and I don't think it'll roll here. Of course it won't. Oh well, maybe next week. I'll bring it up here,
all the rage these days.
And we'll get it up there. But it's an interesting video, and maybe we'll show it at the beginning of next week's broadcast. All right, sorry about that, guys. I thought I'd have a treat for you here. It was a spur of the moment idea, didn't work. So with that, as always, give us a call. What? I think it's working now. Here it goes. If you just bear with us another minute, and I'll share screen. You can hear it. Let's see if we can. This, folks, if you can see this, hopefully it's coming through. Is the showing the whole? It's showing the whole video. I didn't want that. I apologize. See if we can fast forward it here. We'll get a little further.
Man, so what is it being on television? We know all the lines and everything. All we do is wait for some guy.
All right, technology is not. No, what do we? Here.
I'm about to prepare a dinner.
This is it, guys.
I'm a chef. Now this table is loaded with old-fashioned household gadgets. That's why I'm the chef of the past. Boy, oh boy, what a hard job trying to put a meal together with these old household gadgets. Like this piece right here and this corkscrew over here. Phew. I wish that somebody would have been a household utensil that would do the work of all of these.
All right, it's good. It's taking a bit too long, but you get the gist. One product that does everything. We don't need individual securities. We just need the handy dandy packaged, that'll take care of rising rates, falling rates, high inflation, low inflation, growth, and income all at once. Now we'll do it the modern way until reality hits and you wish you had a diverse portfolio. That's all we have tonight. If you need to contact me, call me during market hours, 570-424-1555. Drop me an email, thomas.byrne, that's B-Y-R-N-E, at WS&M, Whiskey Sierra, the word and, M as in Mike.com. And by all means, call us if you have any questions, comments, criticisms, questions on the market, want the real story on something you might have heard or overheard. We'll straighten it out. Thus far, we've done a pretty good job calling the situation as best as we could. Still don't see rates rising. Still much. Still don't see inflation building. See China, which, think about it, has 1.4 billion people. We have 300 odd million people. Yet our economy is double the size. Tells you something's wrong with their structure. By now, it's something wrong with how they're running things. If our central banks and Western central banks have trouble with managing an economy, with the best and most experienced minds in the world. What makes you think China can do it? Probably can't. With that, have a great night, and I will see you next week. Goodbye.